Missing this required minimum distribution deadline could trigger an IRS penalty that many retirees never see coming until after the mistake has already happened. And if you're age 70 or older, especially if you have an IRA, a 401k, a 403b, or you've inherited a retirement account, this is something you need to pay close attention to. The reason this matters is simple. Required minimum distributions, often called RMDs, are not optional once the rules apply to you. The IRS expects certain retirement account owners and beneficiaries to withdraw a minimum amount every year. If that withdrawal is missed, delayed, or calculated incorrectly, it can lead to penalties, extra paperwork, and unnecessary stress. What surprises many seniors is that RMD mistakes happen even when people believe they are doing everything correctly. A missed deadline, an inherited account with different rules, a forgotten IRA from years ago, or a simple calculation error can create a problem that affects your retirement money. Today, we're going to walk through who must take RMDs, when they begin, how they're calculated, common mistakes that trigger penalties, special rules for inherited accounts, and what options may exist if you discover an error after the fact. By the end, you'll know exactly what documents to review and what actions to take so you can avoid costly surprises. Let's start with the basic question many retirees still have. What exactly is a required minimum distribution? An RMD is the minimum amount that must be withdrawn from certain retirement accounts each year after you reach the age specified under federal tax rules. These accounts receive tax advantages while you are saving for retirement. Eventually, the government requires withdrawals so those funds can become subject to income taxes. Many people assume they can leave retirement funds untouched forever. In reality, once RMD rules apply, you generally must take at least the required minimum amount each year, whether you need the money or not. And this is where many seniors get caught off guard. Some retirees focus on investment performance and account balances but overlook distribution requirements. Others assume their financial institution automatically handles everything. In some cases, that happens. In other cases, it does not. The responsibility ultimately falls on the account owner or beneficiary. Now let's talk about eligibility because this area creates a lot of confusion. The age at which RMDs begin depends on the rules that apply to your situation. Different age groups may be operating under different requirements because federal laws have changed over time. Many retirees hear friends discussing RMDs and assume everyone follows the same age threshold. That is not always true. Your required beginning date depends on your circumstances and the laws that apply to your retirement accounts. This is why it is important to verify your specific situation rather than relying on information from friends, relatives, or neighbors. Even a well-meaning conversation can lead someone to believe they have more time than they actually do. And when it comes to RMDs, timing matters. A delay of just a few months can create complications that are much harder to fix later. Another area that deserves attention is the type of retirement account you own. Traditional IRAs generally fall under RMD rules. Many employer-sponsored retirement plans also require distributions. However, not every retirement account follows identical requirements. This is where people sometimes make assumptions that create expensive mistakes. Someone may have multiple retirement accounts and think one withdrawal satisfies all requirements. In reality, different accounts can have different distribution obligations. Others may believe their account custodian is monitoring every deadline. While financial institutions often provide notices and information, you should never assume someone else is fully responsible for compliance. Reviewing your own records remains one of the most important steps you can take. Now let's discuss how the required withdrawal amount is determined. Many seniors think the IRS simply assigns a fixed number. That is not how it works. The amount generally depends on factors such as your account balance and life expectancy tables used for RMD calculations. As account balances change, required withdrawals can change as well. For example, imagine two retirees of the same age. One has a retirement account worth $100,000. Another has an account worth $500,000. Their required distributions will not be the same because their account values differ. This means your RMD is not a number you should assume remains constant year after year. A withdrawal that satisfied the requirement last year may not satisfy it this year. Many people don't realize that a simple failure to recalculate can create a shortfall. And even a partial shortfall can become a problem. Let's say your required withdrawal was $8,000, but you only withdrew $6,500 because you relied on an old estimate or incorrect figure. You may believe you've met the requirement because you took money out of the account. The IRS may see it differently. The issue is not whether a withdrawal occurred. The issue is whether the full required amount was distributed. This is why annual review is so important. Now let's look at one of the most common situations that leads to missed RMDs. Multiple retirement accounts. Over the years, many retirees accumulate several accounts. An IRA from one employer, a rollover account from another job, a retirement account opened independently, perhaps an inherited account received from a spouse or parent. After decades of saving, it becomes easy to lose track of everything. Many seniors discover old accounts they forgot existed. Others remember the accounts but assume they contain balances too small to matter. Unfortunately, the IRS does not necessarily see it that way. An overlooked account can still carry distribution obligations. This is one reason annual account reviews are so valuable. Make sure you know exactly how many retirement accounts you own. Verify account balances, review statements, confirm whether RMD requirements apply. And don't forget inherited accounts, because inherited retirement accounts often create some of the biggest misunderstandings. Many beneficiaries believe inherited accounts follow the same rules as accounts they personally funded. That is not always the case. Inherited retirement accounts can be subject to special distribution requirements that depend on factors such as your relationship to the original owner and the timing of inheritance. This area has generated considerable confusion over the years. Many beneficiaries assume they can simply leave inherited funds untouched indefinitely. Others take distributions without understanding the applicable rules. Both situations can create problems. If you've inherited an IRA or another retirement account, reviewing beneficiary records and understanding the current requirements is extremely important. Many people focus on the account balance but overlook the beneficiary paperwork that determines how the account is treated. That paperwork can have a significant impact on withdrawal requirements. Another mistake that often occurs involves deadlines. Even people who understand RMD rules sometimes forget the calendar. Retirement brings freedom, but it also means managing more financial responsibilities yourself. Without a work schedule and employer reminders, important dates can slip by. Many retirees intend to handle distributions later in the year. Then, life happens. A medical appointment, family obligations, travel plans, a move. Unexpected events. Suddenly, December arrives and the withdrawal still hasn't been completed. This is where mistakes happen. Waiting until the final weeks of the year leaves little room for correction if there is an issue with processing, paperwork, or calculations. Many financial professionals encourage retirees to review RMD obligations well before year-end. For this reason, the earlier you verify everything, the more options you have if something needs attention. Now let's discuss penalties because this is the part that concerns most people. The IRS has historically imposed penalties for missed RMDs. Many seniors are shocked when they learn that failing to withdraw required amounts can carry significant financial consequences. The exact impact depends on the circumstances. But the key point is this: missing an RMD is not something you want to ignore. Some people discover the problem months later while preparing tax documents. Others find out after reviewing account statements. Still others learn about it when working with a tax professional. By then, additional steps may be required to address the issue. This is why prevention is far easier than correction. A few minutes spent reviewing requirements today can potentially save substantial time and money later. But what if you already missed an RMD? This is where many retirees panic unnecessarily. A missed distribution does not automatically mean all hope is lost. The IRS has procedures that may help taxpayers correct certain mistakes. Depending on the situation, there may be opportunities to take the missed distribution, explain the circumstances, and seek relief from penalties. However, these situations are often handled on a case-by-case basis. The important thing is not to ignore the problem. Many people delay action because they feel embarrassed or overwhelmed. Unfortunately, delays can make matters worse. If you discover a missed RMD, addressing it promptly is usually much better than pretending it never happened. This is another reason accurate records matter so much. Good documentation can make the correction process much smoother. Let's talk about the records you should keep. First, maintain copies of IRA and retirement account statements. These statements help verify balances and account information. Second, keep withdrawal confirmations and distribution records. These documents provide evidence that withdrawals occurred and show the amounts distributed. Third, preserve beneficiary documentation for inherited accounts. Many seniors underestimate the importance of these records until questions arise later. Fourth, save tax forms associated with retirement distributions. These records can become extremely valuable if you ever need to verify transactions or respond to questions. Organized documentation does more than reduce stress. It can also help identify problems before they become expensive. For example, suppose you review your year-end records and notice a retirement account showing no distributions. That discovery might allow you to investigate before a small oversight becomes a larger issue. Another important point involves communication between spouses. In many households, one person manages most financial matters. When that person becomes ill or passes away, the surviving spouse may suddenly inherit responsibilities they have never handled before. This can increase the risk of missed distributions. Even if one spouse manages investments, both spouses should have a basic understanding of retirement accounts, locations of records, beneficiary designations, and distribution requirements. Many families overlook this step until they are forced to deal with the financial emergency. A simple conversation today can prevent major confusion later. Now, let's address another overlooked issue. Some retirees believe that because they don't need the money, they can simply skip distributions. Unfortunately, financial need does not determine whether an RMD is required. You may have pension income, you may receive Social Security, you may have substantial savings outside retirement accounts. None of those factors automatically eliminate RMD obligations when the rules apply. The IRS focuses on the required withdrawal, not whether you intend to spend the funds. This catches many people by surprise. They think leaving money invested is always the safest approach. But ignoring a required distribution can create a larger financial problem than taking the withdrawal itself. There is also confusion about taxes. Many seniors worry that taking an RMD will increase taxable income. In some situations, that concern may be valid and should be discussed with a qualified tax professional. However, trying to avoid taxes by skipping a required distribution can create separate compliance issues. The goal should be understanding the rules and planning appropriately rather than avoiding required actions. Planning is often the difference between a smooth retirement and an expensive mistake. Another area worth reviewing is account consolidation. Many retirees have accounts scattered across multiple institutions. While consolidation is not right for everyone, some people find that fewer accounts make RMD tracking easier. The more accounts you have, the greater the chance that one gets overlooked. Many seniors miss this simple risk factor. They focus on investment performance while ignoring administrative complexity. Sometimes the biggest threat is not market volatility, it's forgetting a required action. That is why periodic account reviews are so valuable. At least once a year, take time to verify every retirement account you own. Review balances, review beneficiaries, review distributions, review tax documents. Confirm that records are accurate. These simple steps can prevent many of the problems retirees encounter. Let's also talk about inherited accounts one more time, because this is where almost nobody realizes how easy mistakes can occur. A beneficiary may inherit an account and leave it untouched for years, assuming everything is fine. Later, they discover withdrawal requirements existed all along. Another beneficiary may misunderstand whether annual distributions are required. Others may fail to update records after inheriting an account. These mistakes often happen because inherited retirement accounts involve rules many people never had to learn before. If you've inherited a retirement account, don't assume the rules are identical to those of your personal retirement accounts. Verify the requirements carefully. A little research now can prevent a very unpleasant surprise later. As we wrap up, remember that RMD compliance is really about staying informed and staying organized. The biggest mistakes usually are not intentional. People forget. They misunderstand a rule, they overlook an account, they rely on outdated information, or they assume someone else is handling everything. Those small oversights can become costly. The good news is that many RMD problems are preventable. Review your retirement accounts regularly. Keep accurate records. Maintain copies of statements and withdrawal reports. Verify beneficiary information. Understand the rules that apply to inherited accounts. Pay attention to deadlines. And if you discover a mistake, address it quickly rather than delaying action. The most important takeaway is that required minimum distributions are not something to place on the back burner. They affect your retirement accounts, your tax reporting, and potentially your finances if deadlines are missed. Take a few minutes to review your IRA statements, withdrawal records, beneficiary documents, and distribution history. Make sure every account has been accounted for. Verify that required withdrawals have been completed. And if anything seems unclear, get clarification before a deadline passes. A small review today could help you avoid a costly IRS problem tomorrow. Subscribe and share this with someone who may need this information.